Hey, this is Current Yield, Grant's Interest Rate Observer of the Air, and I am Jim Grant. And Evan Lorenz, the great deputy editor of Grant's, is to my left, and Henry French, our sound engineer, is directly across the room. And as you can see, ladies and gentlemen, we are broadcasting from the storage room and library and utility rec room of Grant's Interest Rate Observer in New York. And we have a guest today, as is our wont, and he is Adam Simmons. And you'll hear more from and about Adam in just a moment. I can say, by way of preview, that Evan Lorenz, who is no mean judge of knowledgeable financial people, counts Adam as about the most knowledgeable and I don't know, influent interlocutor with whom he's ever spoken. I think that's the best, right?
There's people who speak finance and there's people who speak English, but there's not many people who speak both languages, and I think Adam does a good job of that.
Well, we'll find out for ourselves, won't we, Adam, in just a few minutes. In the meantime, I wanted to tell, before we get into merely terrestrial things, this, by the way, this is, we published an issue of Grant's last night, so this is Wednesday, and I'm speaking for myself only, but for me, the day after the publication date is like December 26th of the North Pole. I am a zombie. I succeed mostly in sitting upright with my eyes open. Do you ever catch me nodding off on Wednesday after we close?
It's hard to say over my seventh cup of coffee.
Yeah. But, and also the Wednesday after the Tuesday is given over to some degree to topics not directly related to buying low and selling higher interest rates or other fixtures of high finance, but rather look outside ourselves for a day, right? So I have in my hand a printed copy of spaceweather.com, which is something you can get as do I. It comes to you intermittently. It's web-based news source. And if you want to know about geomagnetic storms and solar winds and X-ray solar flares, but it's not for those things alone that I get spaceweather.com. It's just every once in a while they tell you something you didn't know or had no reason to expect you'd ever know. For example, Adam and Evan, the dung beetle is a singular creature on God's earth. This is the Scarabæus satirus dung beetle. And the headline is the dung beetles navigate using the Milky Way. That's what spaceweather.com says. And there's about 800 words about this, and I'm not going to give you each and every word, just a couple of highlights. But I mean, Charles Darwin might have been right. To me, this is proof positive that there is a God above, and that God has a very fey sense of humor. Here's the lead sentence in the dung beetles navigating using the Milky Way story. Quote, when you hear the words dung beetle, you probably think of poop. Well, yeah, that's probably right, Henry? Yeah. But no, you shouldn't think of something so low as that. Yet, to be sure, that's what dung beetles eat. It's what is on the tin. But the fact is that dung beetles can navigate and do navigate, their eyes raised up to the sky, Evan, as ours ought to be periodically, catching the Milky Way, not exactly examining every star, but seeing the bright light. And as James Foster himself, the University of Constance in Germany says, quote, they are excellent little astronomers. Okay, that's the most amazing. I mean, that's amazing enough, but still more amazing. This gets us back closer to Earth and closer to Adam Simmons and to the digital infrastructure world, is that there are actually pioneers in dung beetle research. This is not some sort of academic dead end. This is a thriving area of research. I had no idea.
If I can interject?
No. Oh, yes, sorry.
It does contrast with their central bankers who stare at their navels and try to find an R-star, an imaginary one.
Right. Well, I think they'd be a little bit in better mental health if they paid more attention to spaceweather.com. And by the way, to Grant's Interest Rate Observer, and less to whatever they're reading. All right, enough. So Adam Simmons is co-founder and president of Dgtl Infra. That's spelled Dgtl space INFRA. And I conjecture, Adam Simmons, that it means digital infrastructure because you are about that topic. And
yes, absolutely. Yeah. And thanks, Jim and Evan, for having me on.
Yeah. Well, before founding Dgtl Infra, Adam spent nearly a decade in private equity, which we will not hold against him. This is both in New York and London. Adam is a resident both of Florida. That's where his money lives, and he lives sometimes in New York. he takes his money with him from time to time, but he and his money spend time in Florida and New York. And in private equity, he led investment teams focused on deploying capital into the infrastructure and commercial real estate asset classes. So, Evan, why don't you ask Adam what the heck is going on in the world of data centers and cell towers and all this stuff that seems to have been built to a fare thee well during our boom years of ultra low interest rates?
Yeah, so it seems like digital data grows exponentially. Every single day there's more videos to stream, more services from Amazon, which would seem to imply for a lot of demand for data center operators. However, organic growth for companies like Digital Realty and Equinix is kind of mediocre, and returns on capital have been falling down. What exactly is going on?
Yeah, I think in terms of the growth for the publicly traded data center operators, they really are getting a significant amount of their growth from the hyperscale cloud providers. So companies like Amazon Web Services, Microsoft Azure, and Google Cloud. And the growth from the headline perspective, I think, is often talked about in terms of growth and leasing volume. And there's a distinction between volume and pricing, and where the sort of revenue growth is falling short, or in your case, sort of leveling off and flat, is in the pricing. And that's coming up in terms of the bargaining power that these hyperscale, as they're called, cloud service providers, or in that grouping is also someone like Facebook, are really exerting on the Digital Realties and Equinixes of the world in terms of whether it be a renewal lease coming online and it renewing at lower rates, or a multi-megawatt new lease that is progressively over time having being signed at lower rates on a per kilowatt per month basis. So it's tough to grow revenue in the data center sector at the moment.
And why is that? How are the hyperscalers able to put so much pressure on kind of the likes of Digital Realty? If they have kind of the real estate that you need to be in, wouldn't they have some pricing power? Or do the hyperscalers themselves have the ability to build their own centers and kind of disintermediate their customers or their landlords?
Yeah, so I think if you look at particularly for someone on the wholesale side like Digital Realty, they're leasing to a single customer often in these buildings, and they're providing cooling and power infrastructure on 5 to 15-year terms. And their tenant base, although they have hundreds of data centers, is often very concentrated, or at least the meaningful portion of that tenant base is concentrated. So again, it's the Microsofts, the Amazons of the world. And it's a unique sector in that you have such a concentrated customer base that the customers actually have their own power and are exerting that, and they know the lease pricing, and they know what it takes to self-build and develop their own data centers, and they know the costs that go into it. And the equation that they're coming to is basically, if you can build it fast, quick, cheap for me, then I'm willing to outsource with you. Otherwise, I can go build it myself because I know what the replacement costs of these facilities are. I know that, historically, it was much more expensive and the lease rates were much higher. Let's talk about 5 years ago. And then, every single year, it's not, a 1-year trend, a 2-year trend. It's every single year. Lease pricing is declining. And so, over time, as these 5 to 15-year leases roll off, some of them have embedded escalators in them too. They're just significantly above market at the time of renewal. And what that means is that there's a rental reversion, come renewal time. So having such a concentrated customer base driving so much of the leasing is really affecting the hyperscalers. The Digital Realties of this world.
Hey, Adam, for the lay portion of our listening public, what do these buildings look like? Do any of them stand a chance of making the cover of Architectural Digest? I mean, are they glorious buildings? Are they just, kind of Toys R Us big? What do they look like? And what's inside them exactly?
Yeah, so I think this is one of the key points, is that data centers are not your wow factor pieces of real estate that can really command those high rents. It's not a incredible looking office building. It's not a 5-star hotel. It's a often industrial looking building that's low on windows and is simply there to have a multi-megawatt power connection put to it and significant cooling infrastructure inside. Fiber optic connectivity connects underground from multiple different carriers, but it's not visible. So it's very a basic looking building, and they're typically sectioned off into data halls, which allow for different customers to lease different portions within the building. But I would say that the overall building is intentionally nondescript in order to not draw attention from the public. And at the same time, what's unique about it is the human element, I think, is that in data centers, the human element is very low. So when they go to planning and zoning, data centers often will provide some context to the cities in which they're developing these structures and say, this will in fact reduce the trip time or the traffic to the actual site. So it's not impeding the overall city's ability and traffic flow from a congestion standpoint. But what that really means as well is that there are fewer human beings going to these facilities, 80 to 100 for very, very large scale facilities run by Apple or Facebook. We're talking, million square foot buildings. So there's that component. There's the component where a lot of the hyperscale facilities are built in the middle of nowhere, essentially, in very rural places. Think Council Bluffs, Iowa, or Ashburn, Virginia, or even further out in Virginia. So there's no, as I would say, wow factor to the real estate, and it becomes over time, as people learn the concepts of building these facilities, a very commoditized product and a very box-like structure, which provides power, which provides cooling, but even that cooling aspect is being sort of disintermediated because you have a type of real estate within the data center sector called a powered shell, and that's the most basic form of data center, the lowest lease in terms of revenue generation, and that's simply a box that's put up and is connected with power.
A box with just a kind of connection to the internet and to a power company doesn't sound like it's that complex or something that would face a lot of obsolescence risk. Do 10 or 15-year-old data centers remain attractive to tenants, or is there an element of, I guess, technological progress and technological obsolescence within the sector?
Absolutely. I think you hit on a number of good points there. There's data centers that, if we're thinking about a new build today, often it's 25, 50 megawatts. We're even pushing towards 100 megawatt, 200 megawatt facilities. So your older facilities from a power standpoint are perhaps not even capable of scaling up to that level. So they're obsolete from a power perspective. They can also be obsolete from a cooling perspective or a general MEP mechanical. That can be renovated, but it comes at a cost. And whether it makes sense to do that on a larger scale and get economies of scale by doing that in a larger building is a question to ask yourself, than refurbishing a small older facility. And how you have fiber optic connectivity being another important one. The landscape in terms of where fiber is important, which is driving a lot of data center demand, has changed because it's becoming a lot more focused on where the cloud service providers are locating. So if a cloud service provider decides to locate in New Albany, Ohio, outside of a major city, if they decide to locate in Council Bluffs, Iowa, all of a sudden you're building routes from Ashburn, Virginia to these more suburban locations, and perhaps your more traditional inner city urban data centers become less relevant. And so as more data shifts to the cloud, in fact, there's a re-architecting of these different locations of where data centers are needed. And that is also creating obsolescence because you have, in summary, I guess you have location, power, cooling, and a lot of other different things to think about when you use the term obsolescence.
I had read an article a couple days ago about an old Digital Realty data center being transformed into a greenhouse to grow tomatoes. Do these old data centers remain in demand, or are they falling out of use as they just get aged out and bigger, better boxes are built?
Yeah, I think there's a potential for reuse of older data centers in alternative real estate forms, like you mentioned. But often the lease rates and the, let's say, per square foot values for the type of data center real estate that they attract are quite high. So the alternative use scenario, whether it be this growing example that you put, or industrial use or office, that's a much lower value type of real estate in terms of lease rates to put in that same place as a data center. So it's very difficult, and the investor in that property would take a markdown or not be willing to do something with that. And you see that in Northern Virginia, where the property owners often will just hold land for 5-10 year periods because it's not possible to develop any alternative to data centers given the price they pay on a per acre basis for large tracts of land. And so I think in some cases, yes, data centers, there may be an alternate use, but it's not always the case given the embedded value that a data center brings to often, rural land or suburban land, let's say at least.
And in terms of the supply picture, we've seen in many, many industries in the last, 5 or 6 years where easy money has caused outside investors to look for returns and kind of, create too much supply in industries. Have we seen, I guess, a flood of money into the data center space from the likes of private equity, sovereign wealth funds, family offices? And if so, is this impacting the economics of the sector?
Yeah, absolutely. I think, you've seen, and there's really three groups of these type of companies. You have private equity firms that have recently backed a kind of massive take private of data centers. So first off, you had Blackstone, who acquired QTS in a $10 billion deal. Then you had KKR and Global Infrastructure Partners acquire CyrusOne in a $15 billion deal. And then most recently, Switch was taken private in an $11 billion deal. And so why is this important? It's because these, Blackstone, KKR, they're some of the most deep-pocketed private equity firms in the world, with business plans after they take private these data centers at, arguably very high multiples. We're talking 25 times and above, touching 30 times. But the business plans
That's
that
EBITDA?
they're EBITDA, yes. And the business plans that they're, predicated on generating their mid-teens IRRs are predicated on constructing billions of dollars worth of data center capacity, new data center capacity all over the world, United States, Europe, and then they're less active in Asia Pacific, but they're making inroads there. And so all of this competition from the private equity firms creates pricing pressure. You have your second sort of type of vehicle. So those were the former public data center operators being taken private by your largest private equity firms. Then you have someone like American Tower, who at the end of 2021 stepped in and purchased a company called CoreSite for $10 billion, and took that company and amalgamated it into its private vehicle, and is ramping up production of the development capex as well to build more capacity. American Tower has a unique angle on this because their U.S. or domestic growth is quite tepid, let's say, on the tower side, and so they're looking for a way in which to expand their growth. CoreSite being an entirely U.S. based data center operator, they're looking for a way to expand their kind of U.S. growth as a whole, and so American Tower, which I don't have the numbers in front of me, but is a company with a market cap of north of $100 billion, can afford to pay $10 billion and put a tremendous amount of capex into growing CoreSite.
Let me ask you this about the private equity operators coming in and buying these data centers at very fancy multiples. A lot of debt, I suppose, right? They're borrowing a lot of money to do this. And I wonder what interest rates they were assuming in their business plans. And I wonder if there is a margin of safety for LIBOR, or the new benchmark money market rate, SOFR, to go up and up and up, and for the funding costs to impinge more and more and more on their cash flow. Do you see any difficulties arising from this?
Yeah, absolutely. I mean, in the sector, I think you mentioned a great point about the direct impact from interest rate rises. And then there's also the implicit, should the EBITDA multiples or exit cap rates on the back end, be affected by that as well. But I think it's too early to say for those groupings of companies whether the direct interest rate impact has affected their companies. But I would say you do see it in the public markets. Someone like Cyxtera, which is very highly levered. It's a data center operator focused more on retail co-location, so dealing with smaller customers, enterprises on 1 to 3 year contracts, and they have had their stock price nearly halve since their IPO, which occurred, I believe, in just early 2021, and very recently, their stock price has halved, and there is very much some concern of a company like this. Or we're seeing it as well with some of the smaller private operators that focus on particularly retail co-location. And if it's helpful, I can explain the difference between retail and wholesale. But you're dealing with short duration contracts that reprice much more frequently than the leases that Amazon or Microsoft signs. And with this sudden shock in interest rates, it is putting pressure on highly leveraged data center operators, whether they be someone public or there's a number of private names that perhaps weren't taken private just recently, but historically have been private. So someone like Flexential, that GI Partners owns, they recently did a securitization and elaborated on the portfolio metrics of their retail colocation sort of portfolio, and it was less than 50% occupied on a per square foot basis, their facilities, and that's across the board. So I think there is, as you said,
less than 50% is bad, right?
Yeah, I mean, I'm sure people have arguments.
Well, data centers might not need a whole lot of people, but ladies and gentlemen, I suspect that you do. And if you do, look to Indeed. It is the hiring platform where you can attract, interview, and hire all in one place. So do not spend hours on multiple job sites looking for candidates with the right skills when you can do it all with Indeed. So find top talent fast with Indeed's suite of powerful hiring tools like Indeed Instant Match, assessments, and virtual interviews. Hate waiting? Yep. So Indeed's U.S. data show that over 80% of Indeed employers find quality candidates whose resume on Indeed matches their job description the moment they sponsor a job. You, ladies and gentlemen, should join 3 million businesses worldwide using Indeed to hire great talent fast. So Indeed knows that when you're doing everything for your company, you can't afford to overspend on hiring. Visit Indeed.com/grant to start hiring now. Go to Indeed.com/grant. Indeed.com/grant. Terms and conditions apply, as they always do. So cost per application pricing not applicable for everyone. Need to hire? You need Indeed.
You were continuing, Adam, and I think you were also talking about other forms of competition from outside capital.
Yeah, and I think the third grouping of outside capital is really those private data center operators, which I touched on. And every major private equity firm, that's below the level of a Blackstone and KKR also has their multi-billion-dollar data center platform. So if you think of Brookfield Infrastructure, they have a company called Evoke, where they're transitioning from retail colocation to focusing on hyperscale investing. DigitalBridge has a number of data center operators, one of them called Vantage Data Centers. EQT has a company called EdgeConneX. Macquarie has a company called Aligned, and then as well a company called Prime Data Centers. So the list is tremendous in terms of the support from private equity firms for both the take privates at very high valuation multiples, and also the funding of private data center operators to largely build new data center capacity. And I think, and I don't know if you want to go here, but the number one market in which people are building is Northern Virginia. And that is, when you think about whether the data center market is going to work in the future, you have to, have a scrutiny on Northern Virginia in terms of whether that particular market, whether it be Ashburn or Sterling, Virginia, is going to be successful, because it is an immensely competitive environment with 20 hyperscale data center operators competing on RFPs and signing, those very large megawatt, 50 plus megawatt leasing deals, and I can get into that more, but I'll stop there.
That's very helpful, but taking kind of a big picture view before getting into the nitty gritty. So it sounds like rents come down every year, and after you kind of go through these long 10 or 15-year leases, which have, as you mentioned, natural escalators in them, that rents reset down because, rents had fallen over that period of time. At the same time, there's a lot of competition coming to the sector from pretty well-financed people, and maybe interest rates change that over time, but for right now, it means there's a lot of new capacity coming along. What does this mean, I guess, to existing data centers owners' economics? I'm looking at kind of like Digital Realty, Equinix, and kind of the other large players in the sector.
Yeah, I think lease rates coming down are one component of that, and the economic equation is not. So that's from the revenue side. And the economic equation from the cost side is also very challenging. You have construction costs rising, and a lot of the operators have told you, looking backwards, that construction cost, they have it in line, but it's coming. And I think any variance greater than 4% is a material deviation in construction costs, and those are going to be forthcoming in the following quarters. You have tight labor markets for construction, and both of those will hurt development yields going forward. In Europe, you have particular concern from energy prices for operational data centers, and that's impacting returns there, making it very painful for existing operators like Equinix and Digital Realty in Europe. And from what I read in the UK, I think there's more pain to come in terms of energy prices. And then you have the other components to building a data center, which are also challenging. Land parcels are at record per acre prices in Northern Virginia. We're talking 2 million, 3 million per acre. And so what do some of these challenges result in? I think we saw a company that was about 6 months ago, maybe 9 months ago, announced that it was filing for bankruptcy, a company called SunGard Availability Services, which is a more retail co-location provider. SunGard was challenged for a number of different reasons, but one of them that led their European business to ultimately file was a power price spike, which sent the power in Europe to about 7,000 kilowatts per hour, whereas in that circumstance they weren't able to pass this through to their underlying customers. And so I think on a holistic basis, there's a few broken business models out there, particularly on the retail co-location side. And the impacts of interest rates, which were mentioned, the impacts of inflation on the cost side, and then the impacts of pricing are all factoring into, I think, a bit of forthcoming pain for some of the operators.
What about the impacts of COVID, or the delayed impacts of COVID? We saw in kind of the last 2 years a huge boom in kind of online services and shopping online. We saw Amazon do a land grab for warehouses, which it's now trying to walk back from. And this year, we're seeing tech companies starting to lay off employees. Netflix, which is one of the bigger drivers of online traffic, has said that it wants to cut down on its Amazon Web Services spending, according to the Wall Street Journal. And even Google, which pretty much mints money, has apparently told its employees to cut down business travel to just the bare essential critical trips. And this is according to the information. Was there a pull forward in demand for data centers, just given kind of the boom of everybody being online in 2020 and 2021? And if so, is there going to be a hangover from that?
Yeah, absolutely. I think there's a boom in terms of everyone being online, and there's a boom in terms of loose funding, because, and I think it's twofold. So you mentioned someone like Netflix. I think comparables to that, Lyft or Uber pulling back on spending. I think in a prior conversation you and I had, we spoke about Coinbase pulling back on spending. Some of these companies that are buy now, pay later, that are struggling, like an Affirm. They're new enterprise data center tenants. So yes, I think the whole technology ecosystem pulling back from spending on the data centers will have an impact. It was propped up by more use of their services during COVID, let's say, but also a component of that, I think, comes towards the startup side of it as well, where funding is loose, let's say, and companies have hundreds of millions of dollars to spend. And so their developers and engineers are just running as fast as possible, trying to develop the next product and you really using the cloud computing services as an open bar. And so there's not as much oversight from these unprofitable startups at that time in terms of their actual cloud spending. And so as that gets reined in a bit, or as the next funding round, is challenged, let's say, and there is no more funding, there will be less spending on the cloud, and that's kind of a virtuous circle there. And if the cloud service providers are not growing as fast, then they're ultimately, they're not leasing data center capacity as fast, or they're choosing to build instead of lease, which has a longer lag time and ultimately, better economics for them. So they're just delaying certain decisions. So I think it's twofold from the technology sector, and that impacts data center spending across the board, and particularly in markets like Silicon Valley, which is the second largest data center market in the U.S.
One more question for you. So I had always thought of crypto as decentralized because that's one of the key selling points for coins like Bitcoin, Ethereum. But I was browsing through Amazon Web Service white papers, and I noticed that a disproportionate volume of all Ethereum traffic apparently traffics on Amazon Web Services. And I also noticed this week that Ethereum is trying to move from a very computationally intensive proof of work to a very non-computationally intensive proof of stake. Might this have an impact on the sector as well?
Interesting point. I'm not an expert by any means on the crypto space, but I can tell you that you'd be surprised at how many different companies rely on Amazon Web Services or Google, for running and scaling their services, but they just don't disclose it readily. And I think that's a great example. And another one would be someone like Apple, who runs their iCloud storage and has committed to grow on AWS, and so there's a lot of different levers. If the crypto market suffers, then perhaps AWS suffers. But I will steer clear of my expertise in crypto.
Well, sticking with your expertise for a second, you did mention that Amazon Web Services has had a lot of unprofitable tech companies. A large part of why Amazon commands the value it does is because Amazon Web Services is so profitable and has grown so fast, and it's the largest cloud provider in the world. Just given what you're seeing from kind of the capital that's been put in place to kind of service these customers, and kind of how demand might have been propped up artificially by cheap rates, easy money, and venture capital, what is your kind of outlook for the big cloud providers?
Yeah, I think there's definitely potential for their growth rates to slow. They've historically grown at 30s and 40% year over year growth rates, and they're very large businesses, and so you deal with the law of large numbers in terms of having difficulty to keep compounding growth at such a high rate. And then, as you mentioned, the challenges faced by perhaps some of more of the startup community or smaller enterprises cutting back on spending. Could very well see those companies growing at closer to 20%, in the 20 ranges going forward. But I don't think there really is a secular tailwind behind the cloud service providers. So I don't really think we're going to see an inflection negative, let's say, or significantly, below 15% or something like this, at least in the near term. But we'll see. This is one of the first downturns that could be forthcoming, that we would have a good lens into how a recession affects the cloud service providers, because they have really grown up over the past 10 years and have kind of grown through all impediments. So it will be interesting to see.
If Amazon Web Services growth fell to 15% from 30 plus, it would feel like a depression for a lot of Amazon investors.
Absolutely. I think, if Dgtl Realty or Equinix's multiples went to 15 as well, then it would feel like a depression for a lot of investors, perhaps not Jim Chanos, but it is sometimes these shocks do happen, so we have to be ready for them.
Yeah. Well, let's do that. And Adam Simmons, thank you for being with us today. Evan, as always, a pleasure. I'll see you around the campus. Henry, much obliged to you. And ladies and gentlemen, thank you for listening. Until next time, this is Jim Grant on behalf of Current Yield Grant's Interest Rate Observer of the Air.